Hello, and welcome back to All About Business. Today, we're going to go over the definition of what bonds are. So, a simple definition. A bond is a fixed obligation to pay that is issued by a corporation or government entity to investors. Bonds are used to raise cash for operational or infrastructure projects. Bonds usually include a periodic coupon payment and are paid off as of a specific maturity date. Now, who issues bonds? So we have governments as well as businesses. Both of those types of entities actually issue what we call bonds. Now, more about government bonds. Bonds are debt instruments and represent loans made to the issuer. Governments, pretty much at all levels, and corporations commonly use bonds in order to borrow money. Governments need to fund roads, schools, dams, or other infrastructure. The sudden expense of war may also demand the need to raise funds. Now for business bonds. Similarly, corporations will often borrow to grow their business, to buy property and equipment, to undertake profitable projects for research and development, or to hire employees. The problem that large organizations run into is that they typically need far more money than the average bank can provide. Bonds provide a solution by allowing many individual investors to assume the role of the lender. Indeed, public debt markets let thousands of investors each lend a portion of the capital needed. Moreover, markets allow lenders to sell their bonds to other investors or to buy bonds from other individuals long after the original issuing organization raised capital. How bonds work. When companies or other entities need to raise money to finance new projects, maintain ongoing operations, or refinance existing debts, they may issue bonds directly to investors. The borrower, known as the issuer, issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds, also known as bond principal, must be paid back on, of course, the maturity date. The interest payment, or some may refer to it as the coupon, is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. The initial price of most bonds is typically set at par, or $1,000 face value per individual bond. The actual market price of a bond depends on a number of factors, which include the credit quality of the issuer, the length of time until expiration, and the coupon rate compared to the general interest rate environment at the time. The face value of the bond is what will be paid back to the borrower once the bond matures. Most bonds can be sold by the initial bondholder to other investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through to its maturity date. It is also common for bonds to be repurchased by the borrower if interest rates decline, or if the borrower's credit has improved and it can reissue new bonds at a lower cost.